right here, 25. Okay. 2550 is a shelling point. It's the end of this value area. When we get into 2550 up to 2575, price has it moves through those areas easier. You already know that. What just happened was somebody getting out or getting in. There's no way of knowing. This explosion in tape, the queue effectively pulled. Um, what this means is typically price will move away from this after it happens because there's an absence of short-term inventory from somebody most likely getting liquidated. There's 6 ticks of slippage here, so price would revert down to the mean. Instead, at 26 even, you see 94 absorbed. That's partially why I got long, but the second reason is because I've seen this. My market depth is only 10 ticks because it lags my DOM, so I can't see the order being thrown up here, but I see it sit at 27. Here's what happens. The ES is not um, a speculating tool. It's a hedging instrument. The top 500 companies, uh, your job as a fund manager is to invest in these companies, is to invest in the American economy. The ES, which is traded on the Chicago Mercantile Exchange, is the composite of these top 500 companies leveraged and aggregated into a tick size of $12.50 a tick. So, what that means is like if you go short or long in crude oil, you have to price needs to go up and down for you to make money or for you to be profitable or for you to lose money. Um, and so there's no other underlying to hedge in crude oil, right? You can't, there's no like crude oil 2 that you can go short in and then go long in the other one. So the job of an algorithm isn't to produce an edge, but to get the best fill possible for your customer. Um, so they're not speculating, against us. We are speculating on our own. So the edge in what I'm about to tell you is going to happen is not that these algorithms make money by filling this large order. It's that there's 1,000 lots worth of size sitting there that they know is sitting there, and they can fill this order at fair prices for a large amount. And typically, because I said it's a hedging instrument, typically, somebody's selling here. They're buying a thousand. So all these people are buying 1,000 lots, and then somewhere else, the institutions that are buying the 1,000 lots are hedging it out in the underlying. The underlying is the top 500 companies, or they're hedging it out through options. That's what I mean by the ES is a hedging instrument. This creates something called elastic liquidity. That means back to oil. You know how it fluctuates up and down. If you buy oil and it goes down, you're going to lose money, and you eventually run out of money. And when you don't have any money, you don't have any more liquidity, and there's no liquidity in the market. Um, because you can hedge in the ES, people can afford to fill orders and not take directional risk. And if you don't need to take directional risk, you can fill all these orders. The edge doesn't come from the directional move, and these people aren't speculating. It comes from the surplus of liquidity. Like, um, so if like the ES is thicker than the 500 underlying companies, or there's a surplus of 1,000 lots in the ES, being able to fill that order at cheaper prices is good, right? That's what they want to do. So the edge in the ES for people who have real jobs is the surplus of liquidity. So when you see a surplus of liquidity like that, but traders are not traders, algorithms are incentivized to hit them, and because they are price insensitive, because they're hedged out in the other underlying products, they can afford to hit them because they don't take any directional risk. If they couldn't afford to hit them, you wouldn't see them filled. If like momentum would run out and it would go in the opposite direction because of adverse selection, the odds of somebody coming in here and knowing more than you, especially when the order has filled, is higher. And so I'll explain that in a second. The second thing is ES is a thin market. It didn't used to be a thin market, but it's a thin market now. See 29, 31, 26 versus the bonds is like $1,000 a tick. And in thin markets, liquidity is predatory typically, but that's partially because of the capacity to hedge elastically. The thinnest markets that people trade are NQ and ES, and those are the markets that people can hedge out in. So like an iceberg in the bonds will work for the most part. In the ES, it's not the same because the dynamics, the fill dynamics are different, right? So what I mean to say is algorithms are incentivized to hit this order so they can fill orders, and if they know it's real, they're going to chase it. And even if they don't know it's real, there are only certain fixed binary parameters that you can edit in order for your algorithm to recognize a fake order. A person can recognize a fake order very easily. It's moving up and down. The size is reduced, the size is added. Somebody's playing Q games, an algorithm doesn't know that. What's going to happen here is because the order's been sitting there, the odds are that it's real is high. So typically, you see price move up to the order. You see a little bit of absorption, and then price moves back and stabilizes. You form an auction, and then it moves back up. Now, the problem with this trade that I threw on, it's good. I bid at value, which isn't something you always want to do, but I did anyways. Is I don't have an order flow trigger to get out. I'm just going to take like a 5 tick loss if it fills me because my base stop is 5 ticks. I think I move it 1 tick there. And the second part is because everybody knows this order, everybody believes this order is real, and it's been sitting there for a while. You're going to see a lot of participation from people who want to fill the pile in. So you're going to see people like there are all sorts of algorithms chasing this. There are algorithms called sniper algorithms who will sit the moment the order is filled and they have a fast connection to the exchange and they'll pile in. And so all these other algorithms will hit this order and see free liquidity, and price will jump typically 2, 3 ticks. This time it only jumped one, meaning the book is thick. And the fact that 1,000 lot got filled and it only jumped one and there was absorption after it, I'm getting ahead of myself, tells me already that sellers are willing to provide liquidity here, up here, and they think it's a winning trade to provide liquidity up here. So the odds that we go higher after this, especially because it's a real order and it's going to empty out the short-term inventory, is low. If that didn't make any sense, I don't have to tell you, tough luck, right? And not to count this vacuum here also, that typically results in price reversing, and it didn't. And we're also outside of this profile area, so it's like an A plus trade. This is one of the best trades you can have, I think personally. It's one of the best things I've seen. Okay, there's the absorption 410. The person who absorbed is the same person who posted the 1,000 lot. And then 118, more absorption, more buy absorption. So I'm looking for price to stabilize 4 or 5 ticks away. If it doesn't stabilize, that means all these buyers got absorbed, and I'm in a losing trade. But typically, what happens, even in the smaller orders, is the market will come test to see if it's real, and if it pulls, it'll come up and stop. There's going to be some absorption, and if the order pulls, then the market does whatever it wants. But if the order stays, then that's a stronger indicator it's real, and so they're going to go for it. So order flow normalizes here. There's still big absorption at 26 from somebody. We see price down tick. There's still an auction here on both sides. Not something I'm worried about. And I put my target 2 ticks back. I'm waiting for slippage from all these algorithms that are piling in. Okay, it trades. And see how price doesn't move up. There's a tick of slippage there. 31 trades at 36, 27, 25. Uh, but like I said before, the fact that it didn't slip more ticks tells me they're willing to provide liquidity. Sellers are up there, and so with an empty inventory, the odds that we revert are high. But I'm looking for an order flow imbalance, and that technically constitutes an imbalance, but it's more of a like a real trade to trade off of. I was looking more for like you're looking more for something like buyers to hit in and sellers not to be on the tape, and then strong liquidity to absorb them. That's really not there. So price moves up and then flow normalizes, and look at the inside print. It's sell driven, yeah, but there's still buyers there on that side. It's light on the buy side. Down here. So the point of that order was twofold. One, he absorbed like 500 lots, so he wanted to sell there, and then the 1,000 lot got hit for like another 100, 1,100, right? He just wanted to get out. I flipped long. This is unrelated. Let me fast forward. See this? 931 and 84, 2875. We're chasing the other thing. I think this order's real. I'm thinking about getting in here. I can't remember why I didn't get in. Okay, look. See, 321 trades absorbed 2875, a tick off 929. Then the order, wait, then the order disappears. Okay? And I told you my market depth is only 10 ticks, so I can't see, but it's probably higher up here. Now here's what's going to happen. Because of adverse fill selection, right, the market is pricing in that order 929 as a liquidity target, one, and as sell pressure simultaneously, which is hard to explain. But the market's pricing it in. Now it's gone. The market has to reprice, and because it interpreted it as sell pressure, it's probably going to lift higher. And sellers, market makers who have bids here and are providing liquidity because they don't want to be subject to adverse fill selection, they don't want to sell at a loss. And if they think the market's going up, and they think the market's going up because the 929 disappeared, right? And so there's less seller resistance now. If they think the market's going up, they're going to raise their quotes. Because if they stay at 28.25 and provide liquidity there, somebody will buy off of them, and somebody will buy off of them and sell higher. So they end up piling over each other as the market adjusts for value. And so you see a 4 tick move up off of that, and then some more, 5, 6, 7 ticks total from the absence of liquidity. So the market adjusts and the order pulls. The book is thin. Even though there are buyers there, the book is thin. And then it normalizes, and then my tape ends. Right now, what that person was doing on the second time, first time he wanted to get filled, second time I told you all these algorithms are binary, and they're not real people, so they just interpret data, and I think if it meets the correct conditions, they make decisions off of that. So what this person's doing, and because the ES is an illiquid market, and that makes a liquidity target, that makes it technically a predatory market, if that makes sense, because they're hunting liquidity, and because they can and since it can be hedged out, they can afford to have price go in one direction for a very long time. What this person is doing is he's magnetizing price upwards, partially leading the market on. Also, there could be some fundamental value. I don't believe that an entire move can be dragged up by a 900 lot in the ES, though it's very possible. So he fills the first 1,000 lot and the 400 down there, and then the market thinks the other one's real, and so he absorbs 300, he offloads 300 there, and then he wants to sell the rest at higher prices. So he pulls the order that the algorithms were chasing and he stuffs it 10 ticks higher. And then he's going to sell at higher prices again, probably using the same method until he doesn't have anything else to sell, and then he's going to leave the market. So he didn't want to fill the 900 lot that he spoofed. He just wanted the 300, and then he wants to sell the other 900 or however much he has left at higher prices. So he's going to drag these algorithms up, and they're going to lose money chasing this order, and then he's going to disappear.